Welcome. Today, we're diving into an exciting topic, how investing in stocks works. If you've ever wondered how people make money in the stock market, or what it really means to own a piece of a company, you're in the right place. Investing in stocks is a powerful way to grow your wealth over time, but it can also seem intimidating if you're just getting started. Don't worry, we'll break it down step by step so that by the end of this session, you'll have a clear understanding of how stock investing works and how you can start using this strategy to build your financial future. What are stocks? Let's start with the basics. A stock represents ownership in a company. When you buy a share of stock, you own a small piece of that company. Imagine if your favorite coffee shop, like Starbucks, decided to expand and needed more money to do so. Instead of taking a loan, they could sell tiny pieces of the company. These are stocks. By buying a share, you're essentially saying, I believe in this company, and I want to be a part of its growth. Why do companies issue stocks? You might wonder, why would a company want to share ownership? Companies issue stocks to raise capital. This helps them fund new projects, hire more staff, develop new products, or expand into new markets. For instance, when Apple or Tesla launches a new product, part of the funding often comes from selling stocks. By selling shares to the public, the company receives money, and investors get a chance to share in its profits through price appreciation and dividends. How do you make money from stocks? There are two main ways to earn money with stocks: capital gains and dividends. Capital gains. This is when the price of the stock goes up from the price you bought it at. For example, if you buy a share of Amazon at $100 and it later rises to $150, you earn a capital gain of $50. Dividends. Some companies distribute a portion of their earnings to shareholders in the form of dividends. It's like getting a small payout for being a part owner. For instance, if you own shares of Coca-Cola, you might receive regular dividend payments as a reward for your investment. How do you buy stocks? Buying stocks today is easier than ever before. All you need is a brokerage account. A brokerage account is like a bank account, but instead of holding cash, it holds investments like stocks. Platforms like Robinhood, Charles Schwab, and Fidelity allow you to buy and sell stocks from your phone or computer. Once you set up your account, you can start searching for companies you want to invest in. For instance, if you believe electric vehicles are the future, you might choose to invest in companies like Tesla or Rivian. Before investing, it's always a good idea to research the company's performance, industry trends, and current market conditions. When should you invest in stocks? Timing the market perfectly is nearly impossible, even for experienced investors. However, a common strategy is dollar-cost averaging. This means you invest a fixed amount of money at regular intervals, regardless of whether the stock market is up or down. For example, you might decide to invest $200 in the stock market every month. Over time, this strategy helps reduce the impact of market volatility because you're buying shares at different prices, sometimes higher, sometimes lower. Current events also play a significant role in stock prices. For instance, during the COVID-19 pandemic, stocks in the technology sector like Zoom and Netflix soared as people shifted to remote work and entertainment. Conversely, airline stocks took a hit as travel restrictions were implemented. Staying informed about global and economic trends can help you make better investment decisions. What are the risks of investing in stocks? Investing in stocks can be rewarding, but it's not without risks. The stock market can be volatile. Prices can rise and fall quickly based on news, company earnings, or global events. For example, if a major tech company like Meta, Facebook, reports lower than expected profits, its stock price might drop, affecting investors who hold those shares. One way to manage risk is by diversifying your portfolio. This means spreading your investments across different sectors and industries. For example, instead of investing all your money in tech stocks like Apple and Google, you might also buy shares in healthcare companies like Pfizer or financial services like JP Morgan Chase. Diversification helps reduce the impact of a downturn in any one sector. Who should invest in stocks? Almost anyone can benefit from investing in stocks, whether you're saving for retirement, a big purchase, or simply looking to grow your wealth. Historically, the stock market has provided an average annual return of about 7 to 10%, outperforming other types of investments like bonds or savings accounts. However, stock investing isn't a get-rich-quick scheme. It's best suited for those who have a long-term perspective and are willing to withstand short-term market fluctuations. If you're thinking about getting started, ask yourself, am I ready to invest money that I won't need for the next 5 to 10 years? If so, the stock market could be a good fit for you. How can you start investing? Actionable tips. Set clear goals. Decide what you're investing for: retirement, buying a home, or building an emergency fund. Your goals will help determine the types of stocks you invest in and the strategy you use. Do your research. Look into companies you're interested in. Check their financial health, read the latest news, and understand what they do. Resources like Yahoo Finance or Bloomberg can provide valuable insights. Start small. If you're new to investing, start with a small amount of money. Many platforms allow you to buy fractional shares, so you don't need hundreds of dollars to get started. For example, you can buy a fraction of a high-priced stock like Alphabet, Google, even if you only have $50. Call to action. Write down one company you're interested in and research its stock performance this week. See how it changes and learn what factors might be influencing its price. Recap and summary. To wrap up, let's go over what we discussed. Stocks represent ownership in a company, and investing in them can provide returns through capital gains and dividends. Companies issue stocks to raise capital, and investors buy them to share in the company's growth. You can easily buy stocks through brokerage accounts like Robinhood or Fidelity. Risks are part of stock investing, but they can be managed through strategies like dollar-cost averaging and diversification. Almost anyone can invest in stocks, but having a long-term perspective is key to success. Closing statement. Investing in stocks can seem overwhelming at first, but with a clear strategy and the right mindset, it's a great way to build wealth and secure your financial future. The earlier you start, the more time your investments have to grow, thanks to the power of compound interest. So take that first step, do your research, and begin your journey into the world of stock investing. Happy investing, and remember, every expert investor was once a beginner. Thank you for listening, and I hope you feel more confident about how investing in stocks works. Now, it's your turn. What's the first stock you want to learn about? Go ahead and make your pick.